OSFI has said that up to 76% of mortgages are coming up for renewal before the year 2026. Notwithstanding the fact that there are over 2.8 million homes coming up for renewal in 2024 alone who have or are going to renew, there's a lot of anxiety in the air among people. What do I do? Where do I go when I renew my mortgage? And isn't it even going to be an option? Now, it's been reported time and time again, we're about to come up with a renewal crisis, a debt cliff, people losing their homes. But is that actually a reality, or is the news just creating unnecessary stress in the marketplace? I think it's a little bit of both. So watch this video if you want to understand what you can do when you have a mortgage renewal coming up in the next couple of years, or you're genuinely interested in what options are available to take advantage of your bank at this time. Now, unless you've been hiding under a rock, you know that during the years 2020 to 2021 and 2022, most Canadians were very interested in renewing their mortgages and refinancing to be able to access rock bottom low interest rates. And during that time, a large percentage of people took a variable rate or a fixed payment variable rate mortgage. Many of them also took low fixed rate mortgages, in many situations below 2%. Well, all of those people who were riding the wave of low interest rates or low payments during that time are about to come into a major potential shock when it comes to their mortgage in the years 2025 and 2026. And OSFI has already flagged mortgage renewals and the real estate market as a big upcoming risk for the years 2025 and 2026. Now, many people we know are already concerned, feeling anxious, unaware, and literally uncertain as to what to do or if they could lose their home with the upcoming mortgage renewals coming into place. Now, there's no fix for higher interest rates, and we are all hoping for rates to come down in the coming 1 to 2 years, but it's generally assumed at this point right now, rates are not coming back to the same as they were in 2020 to 2022. Now, even despite higher interest rates, there are opportunities for people to save money on their mortgages. And unfortunately, a large percentage of Canadians, over 40%, are paying substantially more on their existing renewals than they have to. That doesn't have to be you. And we're going to cover specifically what the process looks like to get a renewal on your mortgage, how early you should reach out, and what you need to consider if it's your time to get your actual renewal done. Now, first off, why is a mortgage renewal so important? Now, unlike the United States, where Americans can take terms anywhere between 15 to 30 years on average, they're locked into an interest rate for that period of time. In Canada, the average conventional mortgage term that's typically taken or has historically been taken in the modern era, which is the last 15 years, has been a 5-year term. Now, previous to that, we saw a lot of Canadians taking shorter terms, 2 or 3 years, and in the last 2 years, the 3-year mortgage has made a big comeback. That being said, a mortgage renewal is a very important time for a homeowner, and it is the time at which your mortgage expires on its contract. So in 2020, if you took a 5-year fixed rate at 2.29%, in 2025, you will actually see that mortgage mature, and you will now have to actually consider taking a mortgage option at today's payments and today's amortizations. So what that means to you is if you're a homeowner and you took a 25-year mortgage as a first-time buyer in 2020 at a 2.29% rate, at the end of that 5-year term, you'll have 20 years remaining on your amortization if you had a fixed interest rate mortgage, and now your lender is going to offer you a renewal that's going to come in at whatever interest rates are at that time. Now, there are many Canadians who have already been looking at renewal offers coming in at anywhere between 2 to 4% above what they were paying, who took mortgage rates in 2019. And so those people are already seeing the impacts of the higher interest rates. So exactly how can you approach this is the question that most people are asking. And what are your options available to you? We're going to cover the whole gamut here today. So to start off with, we're going to touch on what your process should be when your renewal term is coming to an end. If it's not coming into an end and you're considering your options, what you should think about, and some of the hacks and tips and tricks that you can do to save money at your upcoming renewal time. Now, the first thing and most important is to actually consider the timeline at which your renewal is coming up. Now, most Canadians, they have an option to renew their mortgage up to 4 months before the end of their term, because that's the time at which most banks will allow you to lock in a rate. So for example, if you're within 4 months of the end of your mortgage term, you have the ability to lock in an interest rate with any lender for 4 months until the end of that maturity. And if you leave your existing lender at the end of that maturity, or if you decide to take an option from them, you can leave them at the end of the term with no prepayment penalties or expenses, which is a very key consideration because typically that's one of the biggest reasons that Canadians don't actually refinance or leave early, which is those prepayment penalties and expenses. So the number one thing for you to do if you're a consumer right now and you have a mortgage coming up is to circle the date that your renewal is coming up in the next couple of years. Number two is to actually look at your existing terms of your current mortgage agreement. And so what I mean by that is you should understand today what type of mortgage product you have. Are you in a fixed interest rate, a variable interest rate? Are you a fixed payment variable rate? Typically the big banks offer these types of solutions. And then what is your balance in your amortization remaining? You need to take stock of those key considerations. The second thing you need to do is be aware of what you did when you first purchased your property. Did you buy your property with less than 20% down or more? Did you buy it before 2016 or after? Have you ever refinanced your property? These different questions will help us to understand what different types of lenders you'll be available and what types of programs are available. Most Canadians just assume that they would just take a renewal offer with their existing bank and it's going to be the best terms that are available to them. While in many circumstances, there is the ability to transfer or switch your mortgage over to another lender depending on what your current situation was and what you did when you purchased your property to be able to save money. An example would be if you purchased your home before 2016 for under $1 million, even today, your property would be considered insurable. So at the end of 2025, if you had an insurable mortgage, you will actually qualify for better interest rates than someone who did not actually do that because you could switch your mortgage over. Now, this is in a circumstance where you actually are not changing the mortgage other than the potential of switching it over to another lender and looking for a specific interest rate. But if you are in a situation where you are this person, typically what's happening is in most circumstances, you just renewed over and over again with the same lender and paid more money than you need to. Now let's double back here because there's a lot of things that you can do at renewal time, but I think you need to understand what your options are before. Now, every different lender has their own renewal policy. Every bank has their own renewal policy. Some will allow you to renew early, as much as 10 months early. Some will allow you to pay out your mortgage at up to 6 months early, meaning you just pay interest at that time. And other lenders will make you wait until the end of the maturity date. In order to understand those terms, you should be asking your existing bank or lender how early that you could renew and how early you could refinance to pay out that lender. You also want to understand what the costs are to be able to get out of that. I mean, that's a fair amount of information, but you want to be asking those questions because that will allow you to understand the benefit, the pros, or the cons of switching to a different bank or a different lender come your maturity time. Now, ultimately, the big question for most people is, am I going to pay more at maturity? And the answer to that question is it depends. Depends on a few factors. Obviously, one, what is your interest rate today? Number two, did you increase your payments? Or are you already on an adjustable variable rate mortgage where the payments already went up? Number three, do you have the ability to extend your amortization? Because right now, if you had a 25-year amortized mortgage and now you're at 20 years, 5 years later, you may have the ability to even stretch that back out to 30 years. We'll talk on options a little bit more later in the video, but just a thought process that you should be considering when you're thinking about your monthly payments. Okay, so let's cut to the chase. You're someone who purchased your property and you got your mortgage back in 2020 and you got a rate of 2.39%. Let's say a 5-year fixed rate mortgage. Your monthly payment would be approximately $2,478 today. Now fast forward, you're coming up to the end of the renewal and you're seeing your lender offering you a renewal term. Now I'm seeing terms all across the board, but I'm going to use an actual one that I just saw last week from a client who was with their existing bank. Their bank offered them a new rate at 5.79% on a piece of paper. Now we all know that's a bit inflated, but that was the rate that was offered. And the crazy thing is that over 40% of Canadians don't even negotiate the terms that they're actually being offered. Now, if they took that 5.79% rate, which would be crazy, with 20 years remaining in the amortization, their monthly payment would go up by $828. This is a significant increase to a new monthly payment of $3,306. That can have an impact on a lot of families' lives, especially if they want to keep their amortization in hand. Now, let's say they take option one, which is to even negotiate with their existing bank, and their bank says, okay, we'll now offer you a rate of 5.49%. I've seen this happen many times as well. That new payment and that new rate would go down just slightly, and the new payment would be $749 more. Now, let's assume this person takes the next step and they actually do some research and they talk to a mortgage broker and they get, let's say, an interest rate for today's sake of 5.09%. If that were to happen, this person would actually see a reduction to their monthly payment to $3,124, which still represents a $646 payment difference. Now, let's further assume that this individual, their monthly payment is very important to them because of their life situation, their cash flow, and they want to be able to keep more money in their pocket. We have the ability to switch to a different lender to extend this amortization, back to 25 years without negatively impacting their overall situation, aside from extending the amortization. Now, in this situation, let's assume we were able to secure a better interest rate because we're switching lenders and they were previously insured. Their monthly payment would now represent $2,742, which is now only an increase of $264. This is based on a 4.99% interest rate and the assumption that someone was able to switch lenders during that time. We'll go one step further. Let's say this person was having a hard time making ends meet, they wanted to keep their home, and their cash flow was paramount. It was number one. Perhaps something happened in their lives and they really need to reduce their payments. They could even go back now to 30 years. We'll increase that interest rate by 0.1% now to 5.09. And now their monthly payment is only $2,544. Now, this is called a refinance, and it's restructuring the loan. And yes, it's going back to 30 years, but you don't have to go back to 30 years forever. This person could do this for a couple of years and then choose to increase their monthly payment. If they chose to increase their monthly payment when rates went down or at the end of the term or their life changed, they would have the ability to reduce the total amortization left on the loan. We've realized that not everybody wants to go back to 30 years, but this is a solution for the problem of the amount of cash flow, because we went from over $700 increase to as little as a $66 increase by looking at those different solutions at that time. Now, let's assume another scenario where someone has taken in 2020-21 a fixed payment variable rate mortgage. This is what many people took during that time because interest rates were in some cases sub 1% or the low 1% range, and there was no indication that we were going to see the Bank of Canada at that time increase as high as it did. So many Canadians took these types of mortgages, and as we've spoken about previously, had hit trigger rates, and we're now at a point where they were in a reverse amortization, which means they're paying more interest now against their property than they had previously actually paid down. Basically, short version is they might not even be covering the interest component, let alone the interest and principal. Now, someone in this situation may not have already increased their monthly payments, and if they haven't, those are the people who would definitely see a higher amount of payment shock. But the reality of it is the biggest difference is the amount of money that's going to have been paid down. If in fact someone took this mortgage in 2021, instead of having paid off approximately $70,000 of principal, maybe they only paid off $20,000 or $15,000. They still have the ability to take that same option to switch their lender, to refinance their mortgage, or to extend the amortization to reduce their payments. It just won't be quite as much. So in this scenario, let's say this person has only paid off $20,000 of principal and they opt to get their payment as low as possible using that 30-year amortization and stretching it out. In this situation, their monthly payment would increase approximately $432 using that option. But compare that to the alternative situation where they took what the bank offered them day one, or they even just did move over to another lender and saw their payment increase to the tune of about $1,185. So no matter how you look at it, there's going to be some increases to monthly payments across the board. There are going to be some families that are going to be realizing some higher costs. And the question mark for most people right now is, okay, how do I cope and what do I do? There's a few things that you can consider. Like we talked about, get stock of where you stand, understand your renewal dates and your renewal times. Number two, look at your current situation. If you're on that variable rate payment mortgage, can you set aside some additional money for yourself? Does it make sense to add a lump sum to that monthly payment? Or can you just start budgeting towards a higher payment at that time? Three different things you can consider. Another thing that you should be doing is you should be contacting a company like ours, for example, that offers renewal monitoring, whereby we actually input your mortgage information into our terms and we actually monitor the mortgage to look for the best opportunity to save money, and we can even lock you in as early as 10 months before the maturity date if it makes sense to do so. Other things to consider at this time is, do you have any other outstanding debts, car loans, credit cards, lines of credit, anything else that you could either A, consolidate into these payments, or B, start paying those off as quick as you can before this renewal comes up and it has a big shock to your monthly payments. Because if you're still paying 2.25% on your mortgage right now, it might make more sense to divert most of that money against your other debts or expenses, especially if they're credit cards or lines of credit and those higher expenses. So what can we expect for interest rates looking into 2025 and 2026? Well, the market is projecting right now a reduction to prime, or the Bank of Canada's overnight rate, as much as 1.75%, that's 175 basis points by 2026. That's the current market projections. And fixed interest rates are set to come down based on the market projections by about 0.25 to 0.75%, depending on which statistics you're looking at. Either way, shape, or form, you're looking at interest rates either in the 4% range or 5% range for fixed or variable rate. And at that time, you should be understanding what is the current product by talking to someone independent who can explain those things to you. But either way, you are going to see an increase to your options. And so what do? My suggestion is number 1, start early, understand where you stand. Number 2, contact someone who can actually monitor your existing mortgage and set you up in such a way that they can reach out to you when you can renew early and discuss your options. And number 3, and most important, be prepared. Don't bury your head in the sand. There's no one coming to save you at this time right now. And essentially, the best thing that you can do is take control of your existing finances. Like anything, this too shall pass. You just have to be prepared, and you can't hide from it.